Imagine you could own a part of Google, Apple, Tesla, and Nvidia and profit from their earnings and increase dividends and share prices. Turns out that you can, either by buying their individual stocks or investing in an index fund or ETF like S&P 500. As a disclaimer, I'm not a qualified investment advisor, so the contents in this video should not be taken as financial advice. When investing, your capital is at risk, so do your own research and seek independent professional advice when required. So with this said, let's start. You might have heard about the S&P 500, which contains the top 500 USA publicly traded companies with the primary emphasis on market capitalization. The interesting part about this is that this list is not manually curated by a human or some opaque heuristic. This list is based on market capitalization only, and is considered one of the best gauges of the large US stocks and even the entire equities on the market because of its depth and diversity. This dilutes the risk that you're exposed to, and historically it has provided a 6% return on investment after inflation. The easiest way to invest in S&P 500 is by using ETFs. ETFs are exchange-traded funds. ETFs and index funds are similar in many ways, but ETFs are considered to be more convenient to enter or exit. Two examples of low maintenance costs S&P 500 ETFs are Vanguard's VUSA, which is a distributing ETF, and in this one the dividends are paid out to you and you can choose to reinvest them, invest them elsewhere, or just cash them out. The other example is an accumulating ETF, the VUAG. In this one, the dividends are automatically reinvested into the ETF, which makes the process more automatic in case you want to reinvest your earnings, which likely you should. But take note that even though these dividends are reinvested directly into the ETF, they are still considered as earnings by the HMRC. So in the tax perspective, there is no difference between distributing and accumulating. Investing on the S&P 500 ETF is already a significant step up from plain low-interest savings accounts, but you would be overly exposed to the USA. As such, you can consider ETFs which further diversify your exposure. For example, the FTSE All-World ETF, which is comprised of large and mid-sized company stocks in the developed and emerging markets. The ETFs that I mentioned are provided by Vanguard, which tends to have a low maintenance cost for their ETFs and can be bought in several trading platforms. But there are many other reputable companies that provide similar ETFs, such as BlackRock. So where can you buy and explore these ETFs? The first reference is justETF, and this is a great website to explore and get details on costs and performance of ETFs that you're aiming to invest in. Next, we've got Vanguard. And if you're starting out on your ETF investment journey, I strongly suggest this platform to invest in your ETFs. Making deposits and managing investments is straightforward, and it has the right amount of information and process in order not to be overwhelming. Next, we've got Interactive Brokers. This platform has been around for a long time, is low cost, well capitalized, provides for very low cost exchange rates, and allows you to invest in a large catalog of available stocks and ETFs. The trade-off is that it takes longer to onboard due to its interface complexity and wide range of tools and information. And finally, we have T212, which is a commission-free platform that doesn't apply any commission on trades, but does charge 0.15% on currency conversion fees. So make sure to take all the hidden costs into account. Vanguard, Interactive Brokers, and T212 are all regulated in the UK by the FCA. And I recommend that you spread out all of your investments in different platforms in case any of them is shut down or rendered illiquid. Every time that you sell an ETF or stock at a gain, for example, you bought £100 worth of an ETF and sold it for 150, and every time dividends are received, regardless if they're paid directly to you or reinvested, you will need to pay taxes on them, unless you are still within the respective allowance. One way to not pay any of these taxes is to use a Stocks and Shares ISA. A Stocks and Shares ISA is one of the types of ISA. The other ones being a cash ISA, which is a type of savings account that offers tax-free interest. The other one being the Innovative Finance ISA, which is for peer-to-peer lending with tax-free interest. And the Lifetime ISA, which offers you a tax-free savings account that gives you a 25% bonus if used in retirement or to buy a first home. At the time of this video, the maximum yearly amount allowed to be saved in ISAs is £20,000. This means that across any of these 4 types of ISAs, you can only deposit in them up to £20,000, and you can withdraw from them at any point in time. Creating a stocks and shares ISA is fairly straightforward. Vanguard, Interactive Brokers, and Trading 212 all allow you to create a stocks and shares ISA account. The account is exactly the same as a normal account, except that it is tax sheltered. Your ISA account will be completely separate from the general account. So the moment that you max out your ISA account, you can just continue investing on the general account. You can create ISA accounts in multiple providers in any types you choose, but remember, there is a global £20,000 limit. For example, if you have a cash ISA on HSBC where you deposited £15,000 and a stocks and shares ISA on Vanguard, you can only deposit up to £5,000 on Vanguard stocks and shares ISA. But you can transfer your ISA account across providers to avoid losing tax-free investments. In another example, imagine that you deposit £18,000 on an ISA account and then withdraw all of it. This means that you'll only be able to invest an extra £2,000 on that year after that. Every year, your annual ISA allowance will renew, and your investments from previous years will still have tax-free gains. As such, avoid at all possible costs to withdraw your investments from these ISA accounts. Even if your ISA investments were made several years ago, their gains will still be tax-free. And finally, just to drive this point home, remember that any capital gains and dividend gains yielded from your investments made on an ISA account will be completely tax-free. This video is a part of a sequence of videos on UK investment strategies. Check in the comments below for another video on how to leverage credit card and cashback rewards for increased gains. And with that, I'll see you on the next one.